Hello guys, welcome to our YouTube channel Stocks for Everyone. GRP Limited, which was once a darling of many of the retail investors, is now down by almost 55% from its all-time high. So in today's video, let us look at the company overview, Q2 and H1 FY26 performance, their business highlights and challenges, their strategic outlook, capacity and operations, their key growth drivers, key risks that you need to monitor, and also few fundamental metrics. So this video is only for educational purpose. We don't intend to give you any buy or sell recommendations. We are not SEBI registered. So please check with your financial advisor before taking any investment decisions. So we are making this video just because many of you requested about a deep dive on GRP in the comment sections. So with that, let's get started. So if you look at GRP, then GRP stands for Gujarat Reclaim and Rubber Products Limited. So if you look at their history, then it's a 50-year-old global leader in reclaimed rubber, recycled plastics, and specialized polymer solutions. It supplies products to 8 of the world's top 10 tire manufacturers, operates across 55 plus countries. Company runs a fully integrated model from reclaimed rubber to crumb rubber, pyrolysis oil, and recovered carbon black. With strong ESG practices and ISCC plus certification, GRP is positioned as a sustainability driven powerhouse. Now, the performance snapshot. In Q2 FY26, GRP reported 1324 crore revenue, which was up 1% year on year. And if you look at the EBITDA grew 13% to 114 crore, while PAT declined to 20 crore due to margin pressures. Margins improved to 9%, rising 95 basis points. And if we look at the H1 FY26 performance, then revenue stayed flat, but PAT dropped because of US tariffs, higher interest costs, and a 2 crore forex loss. So if you don't know what forex loss is, then it's mainly because of the currency conversions that happen. So because of that, their forex loss of 2 crores has occurred. And if we look at the business hits and misses, on the positive side, domestic reclaimed rubber volumes grew 20%, crumb rubber and pyrolysis plant became operational, solar energy is cutting power costs, and new reclaim technology is improving margins. And on the negative side, the plastics division is under pressure. US tariffs caused a 5% volume loss, subsidiaries reported 12 crore loss, and the composites unit was shut down. If you look at the strategic outlook, then management expects a stronger second half with better volumes and higher margins. EBITDA margins are likely to improve by 200 to 250 basis points. FY27 could be a breakout year with the commissioning of recovered carbon black by March to April of 2026, and a total capex of 250 crore is planned in two phases, that is 150 crore for crumb, pyrolysis and RCB, and 100 crore for capacity expansion. If you look at their capacity and operations, then reclaimed rubber runs at 85 to 90% utilization, crumb rubber capacity is over 31,000 tons, and pyrolysis is ramping up. RCB will add 12,000 tons in FY27, and plastics division is operating at just 40%, leaving room for upside. If you look at the key growth drivers, then stricter recycling mandates, high margin pyrolysis and RCB demand, sustainability push from tire makers, lower energy costs from solar power, new reclaim technologies, and India's growing auto sector are all the strong tailwinds for this company. And if you look at the key risks that one should monitor, then rising debt, volatile global rubber demand, uncertainty around US tariffs, weak plastic pricing, and execution risks in the upcoming capex. If we look at the shareholding pattern, then DIS shareholding have decreased in the September 2025 quarter over the previous quarter from 0.38% to 0, that is nil, and FIIs are also very negligible at 0.02%. And if you look at the promoter holding is not that great, they are at 40.06%. And if you look at the public holding is high at 59.93%. So this is something that you really need to consider. Now, before we close this video, let us look at the fundamental metrics and few financial metrics of this company in screener.in. So now we are in screener.in. So let us look at a few financial metrics and fundamental metrics of this company. If you look at the market cap stands at 1046 crores, so which is a small cap company. And if you look at the PE is 38, and if you look at the industry PE is 30.8, so it's somewhere overpriced compared to its industry PE. And if you look at their ROCE and ROE, then ROCE at 17.5 and ROE at 17.4 is decent. And if you look at their current ratio stands at 1.29, which is good. But main risk or big red flag that I see here is with debt to equity. So if you look at their debt to equity, it stands at 1.12, so which is really risky. So one should look at this before they think about this company. And also if you look at their peg ratio stands at 0.54, which is good. So generally people consider peg ratio below 1 to be undervalued, so you can take a note of this. So if you look at FY24, then you can see that the profit is drastically up, and that's mainly because of its OPM percentage. So operating profit margin had expanded from 6% to 11%, and because of this the stock price zoom. And after that, once when their profit margin is settling down, or their profit is going down, now the stock is in correction phase. And you can see that their trailing 12 months is now indicating that their numbers can be less than what they had in FY25. So this could be one of the reasons why the stock is falling down drastically, right? And we discussed previously that its borrowings or debt to equity is at more than 1. So if you look at here, their reserve stands at 176 crores, but their borrowings at 204 crores. So this has drastically went up. So that is something that people should think of. And if you look at the cash from operating activity, then cash from operating activity stands at 45 crores and net cash flow of just 1 crores. And if you look at the shareholding pattern, as we discussed previously, the DIs have completely exited this stock, and even FIIs are looking like they'll exit it very soon. And public holding was high from prior days, but now it stands at 59.93. That was it for today's video, guys. Sorry I could not post any video in last 14 or 15 days because of my dental issues, and I think I'm fine now, so I've come back with today's video. If you find this video useful, then please hit that like button, share it with your friends, and don't forget to subscribe to our YouTube channel. See you guys in the next one. Thank you.